These videos and accompanying PDF package have been prepared by Patricia Malia. Personal use of these items is welcome. However, any use of these videos and package for commercial or monetary gain is not permitted without express consent from the author.
Financial accounting is like a language. Everyone has to understand what everybody is speaking about when we're looking at financial statements that are being prepared. In Canada, we have two sets of principles that we use for preparing financial statements. Publicly traded companies, or companies that have their shares on public markets, must use IFRS, International Financial Reporting Standards. Companies that don't offer their shares to be purchased by the public are allowed to use either IFRS or ASPE, Accounting Standards for Private Enterprises. For this course, the difference between the two standards are not very material. Both of them encompass exactly the same principles that I have noted here. When we do come across any material differences, I will note them for you. On this page, I have noted the principles, etc., that we will be using the most. There are, of course, quite a few other ones, but these are the main ones that I'd like you to know for the course. The first one is the separate entity principle. The separate entity principle just means that when you're looking at a set of financial statements, for instance, XYZ companies, that it includes only the assets, liabilities, equity, and income and expenses for XYZ. What this means is if a shareholder owns a house personally, they are not allowed to put that house on XYZ's financial statements. They have to keep all their personal belongings separate from the financial statements of the company. The unit of measure principle just means that when we're looking at a Canadian company, unless otherwise noted, the financial statements will be stated in Canadian dollars. The numbers on our financial statements are also at historical cost, unless otherwise noted. So what is historical cost? Historical cost is the original invoice price or invoice cost of whatever it is that we have on the financial statements. If you have a piece of equipment, we will be recording it at its original cost that we paid for it. If items are not at historical cost, the only other alternative is to have them stated at fair value. If anything is stated at fair value, we have to let our readers of the financial statements know, usually in a note to the back of the financial statements. So what is fair value? Fair value is the selling price of the item that we have less its cost to sell. So why would we have anything at fair value? In deciding whether or not to use historical cost or fair value, we really use three other separate principles to help us with this decision. Prudence or conservatism means that we should always err on the conservative side when presenting our financial statements. This means that if you have two values to pick from, one showing the value being higher than the other one when it comes to assets, then you should always pick the lower value because we're going to show conservative financial statements. The conservatism principle also requires that any losses that we are aware of should be recorded immediately to let our investors know what is going to happen. The next thing that we consider is how relevant is knowing the information to the reader of the financial statements. If the reader is concerned that inventory costs are much higher than what we would get from the customer, then that is relevant to the reader and we need to let them know. We should only use fair value if the information for calculating fair value is very reliable. How do we know that our inventory can only be sold for $100? If we were simply guessing this, then we won't use fair value. But if when we sell our inventory to our customers, we actually can only sell it to them for $100, that is our outside invoice price, this is extremely reliable information and should be used for calculating our inventory value. There are a couple of exceptions where fair value is used when it is higher than invoice cost. I will talk about these exceptions when we come up to them in the course.